You don't see it coming. One second, everything is normal, and the next, our host drops into the frame like he's fallen from the sky. Papers flying, charts shattering behind him, the sound cutting for half a beat before snapping back in. Not chaos, control. Because while everyone argues about inflation, rates, and the economy, there's a quiet machine running underneath it all. No headlines, no drama. Just numbers moving silently, deciding how expensive your life is going to be. Here's a strange question. If interest rates affect your loans, your savings, your rent, your job, and even your future, why does it feel like no one can ever explain who's actually in charge of them? Is it the government, the central bank, inflation, or something hiding in plain sight that most people never look at? Think about this for a second. When interest rates go up, mortgages become painful, businesses slow down, stocks panic. When rates go down, money flows, risk explodes, and bubbles form. But rates don't move randomly. They respond to something, and that something isn't loud. It doesn't trend on social media. It doesn't give speeches. It just exists, calm, predictable, powerful. That thing is government bonds. Most people hear government bonds and instantly tune out. Sounds boring, old, safe, but that's exactly why they're dangerous to ignore. Because bonds are not just investments, they are signals, they are promises, they are the language the government uses to talk to the market, and the language the market talks back. Let's slow this down. When a government needs money, it doesn't just print it endlessly. It borrows, and it borrows by issuing bonds. You give the government money today, and they promise to pay you back later with interest. Simple. But here's where the quiet machine starts working. Every bond has a yield. That yield is the return investors demand to lend money. When investors feel safe, they accept lower yields. When they feel nervous, they demand higher ones. And those yields, they become the foundation for almost every interest rate in the economy. Your mortgage rate, corporate loans, credit cards, student debt, they all sit on top of government bond yields like buildings on bedrock. Now, here's the unsettling part. The government doesn't directly set long-term interest rates. The bond market does. Millions of investors around the world are constantly voting silently with their money. Buying bonds, selling bonds, pushing yields up or down. No meetings, no announcements, just pressure. So ask yourself this. When bond yields rise, is the government tightening the economy or is the market losing confidence? And here's where anticipation kicks in, because bonds don't just reflect today, they predict tomorrow. If investors believe inflation is coming, they demand higher yields now. If they believe growth will slow down, they rush into bonds, pushing yields down. Bonds move before headlines do, before rate cuts, before recessions are officially announced. That's why professional investors watch bonds like a heartbeat monitor. But wait, if bonds control interest rates, what does the central bank actually do? This is where people get confused. Central banks control short-term rates. Bonds control long-term expectations. When both move together, the economy flows smoothly. When they fight each other, things break. Ever heard of an inverted yield curve? That's when short-term rates are higher than long-term bond yields. It sounds technical, but it's basically the bond market whispering, "Something's wrong." And historically, that whisper has preceded recessions again and again. So here's the real question. Are bonds reacting to policy or forcing it? Because when bond yields spike, governments suddenly care about inflation. When yields fall, stimulus becomes cheap again. Bonds quietly discipline governments. They reward credibility and punish recklessness without ever saying a word. Now, let's bring this back to you, because this isn't just macro theory. This affects real decisions. If you understand bonds, you understand timing. You understand why mortgage rates rise even before official rate hikes. You understand why markets panic when bond yields move too fast. And you understand why safe assets suddenly become risky when confidence shifts. Bonds teach you one crucial lesson. The economy isn't driven by opinions, it's driven by expectations. And here's the validation moment. That confusion you felt about interest rates, it's not because you're missing information, it's because most explanations skip the machine behind the curtain. Bonds are that machine. Once you see it, everything connects. Inflation fears, rate hikes, market crashes, policy reversals. It all flows through government bonds first. Now watch what happens next. Over time, our host changes. The chaos disappears, movements become calm, the visuals sharpen, the voice steadies, because understanding replaces noise. That's trust being built, not claimed. And this is why the next time you hear bond yields are rising on the news, your brain won't shut off. It'll light up, because you'll know what it really means, not just for markets, but for your money, your debt, and your future decisions. Government bonds aren't boring, they're quiet. And quiet things tend to control everything, until you finally notice them. And once you do, you can't unsee the machine.